I mean, student housing, I think there's a well-trodden path of how you look at locations, and some people, if you just look at the UK context, say I'll only invest in Russell University towns, cities. So it depends how you, as a house, look at it. We looked at something in Derby a couple of years ago and couldn't quite get. And Derby as an economic location, very strong, very good. Average earnings much higher than East Midlands, but actually the university not great ranking. Was this a location we felt comfortable going into? We didn't. Another investment manager did ultimately buy that building. So it's different strategies in different locations. In terms of residential, certainly in a UK context, this is an asset class, again, that Marcus suggested, institutions historically have invested in. They then divested, and we feel we're now on a bit of a journey. A lot of the things that a lot of investment managers have had to do with institutional investors over the last 2 or 3 years is education, is explain why this as an asset class is interesting, is compelling, is something they should invest in. And in doing that, you then have to say, well, in our view, you start off in locations where it is straightforward and easy to articulate why you would go into those locations. So Greater London in a UK context is very straightforward. You then look at big 6 provincial towns and cities. They, again, economically viable, stand up in their own right, strong employment base, decent sized population. I always use the example when I talk about this of Cheltenham. Fantastic, you go there for a weekend, Cotswolds racing, nice bit of shopping, decent hotels. But actually, if you look at the employment base in Cheltenham, there's GCHQ, a couple of schools, and some public sector employers. If GCHQ goes, that's a large proportion of your potential tenant base. So at the moment, our view is these bigger, well-established towns and cities are the starting point. I think over time, as investors get more comfortable with this as an asset class, then you can start to look at smaller locations. But if I put up a building of 200 units in Cheltenham, I'm going to be the biggest rental building in Cheltenham forever. If I put up a building of 200 units in Manchester, I'm probably going to be one of the smaller rental buildings in Manchester at the moment. So you start with those. To me, I only do simple things, and you start with a simple philosophy like that, and hopefully then the wise and knowledgeable investors will follow. So that's really our sort of mantra. Going to Germany, just very quickly, our investments are in Dresden, Frankfurt, Cologne and Berlin. I think they would be probably seen as pretty much tier 1 cities. So again, we've followed a similar strategy because we're doing something slightly different to PATRIZIA and other managers in that location. So really tried and tested for us is the starting point.
I think it's very much depending on what type of strategy and what time horizon do you have. I think what we currently see is in a lot of the top 7 German cities, buy and hold investments in resi are getting challenging in the way that the return requirements a lot of institutional investors have are simply cannot be met with the stock that is available in these cities right now. So then you have to find simply, if you want to go to the cities from the risk perspective, because they will definitely be these cities that will always have a solid demand base going forward, then you have to get to the cities with a different kind of strategy. So unit sales or a combination of unit sales and buy to hold is then one of the things. Going outside, at the end for us, it's ultimately the city compared to the demand side and the economic base. It's a combination of these factors you have to take into account. It's not to say that we have cities we favor more or less. It's really depending on what type of strategy you're going forward. We have investors who simply look for IRR based on their investment strategy. There you really need to much more focus on the exit strategy. It's not so much a buy and hold strategy. And the other one saying we are happy as long as we get a 3.5% cash on cash return of our resi investments. And you will simply look at cities from a different angle from their point of view. And then possibly the first IRR driven investor, we might look at London as an opportunity for him to look and buy something and sell it unit by unit. But if you want a cash on cash 3.5% or 4%, you will never go for London as a resi buy and hold investment because you're simply unable to acquire anything. But if you have something, I'm happy to talk to you. But I think it's quite hard to find something here.
Are there markets then where you think they're already at the top and that I mean, what's your sense of that? I mean, in terms of London resi, do you think that's where that's going to be now for a little while?
If you look at prices in London, I would say they might be definitely have reached a very high level. If it might be the top, it's questionable because you're still building not enough. So the risk is that prices continue to rise, although they have already reached a quite high level. But given the global economic developments you see, I think house prices in London in the luxury end might stabilize or even go down a little, as they have done in the last couple of months a little. On the other hand, I would say market, if you look at the German press, you get the impression the German market is already on the top and is peaking. I will a little bit disagree on that because the press always tells you, yes, prices are getting out of reach with rental development, which is quite logical because if the rental development is regulated, it cannot move as quickly as prices can that are unregulated. So how can you say an argument if you compare two things that cannot move freely, one can move freely, the other cannot, and then say if the free moving target is moving faster than the regulated part, then it's getting out of reach with fundamentals. It's not really the case. So I wouldn't even say the German market has not peaked yet. And I don't see any, I think the Swedish market might be one of the few where I would say there is some kind of argument saying that prices have gone very far, I would say, but nevertheless, given also the building situation in the urban areas across Europe, it's quite hard to say that we are really falling, that prices will fall going forward due to a lack of demand or excess supply coming to the market, and that is ultimately what will be a turning point for prices. And I don't see excess supply in any of the urban areas in Europe coming to the market in the next 2 to 5 years.